All right, we are live, and I think well, live, as in we are alive, not infected, not dead, but we are live and alive. So I think there's a lot of things that can be said. What's going on right now? They're using the word pandemic, and we got a bunch of guys here in the office. We got Ricky over there. He's literally sitting 2 feet away from me. We got Joel, we got Sam in his computer doing his thing, and we got a couple other people working from the pleasures of their home, but we were talking about how this affects the economy, and obviously, there's a lot of stuff hitting the fan because of this obvious infection that's going around. Right? Not going to say the word because I think we get demonetized, but um, there's a lot of things that's going on, and it's scaring people. And I saw a couple of headlines, and I just want to number one share my thoughts on everything that's going on, and I want to give you guys some facts and some theories that I have that I think is happening, in my opinion, behind closed doors. I think I'm not alone when I say that typically number one, it's strange that this happens every election year. And number two, I think it's also conducive and also predictable in terms of how things like this affect the market and how it affects my money, your guys' money, how it affects our investments. And what I'm going to try and do at the end of this live stream, which I'm hoping will be no longer than 20, 30 minutes, is I'm going to offer you guys some strategies that I believe has worked and has also worked throughout history in terms of um, any other times where you had such volatility and unpredictability in the market. So let's go ahead and start off kind of like with my overall thoughts. Number one, I think number one, and Sam just whispered to me, you gotta talk about the rates. You got to talk about the rates, which is true. I mean, we do have that is one of the things that we're going to talk about. And then there's another main thing that we're going to talk about as well. But, I think number one, a lot of people think that it's a great time to buy stocks right now. And let me share with you why I don't 100% agree with that. I'm watching, I'm scrolling through my Facebook, just kind of seeing every single little status on the coronavirus or dang it, I wasn't supposed to say that, but I said the C word. Oh, well, it's okay. I don't need to make money on this one anyways. So, I heard a lot of things said about that word. Let's call it the Modelo, right? Just to replace it. About that word. And oh, cool, we got the little thing. So, by the way, I put a Facebook status out last night. I don't know if we're Facebook friends, but I put a Facebook status out last night, pretty much telling anybody who's 70 years old or older that if they need help with groceries or anything like that, I'd be more than happy to help. I encourage you guys to do the same thing, just because you think about the people who are really the most at risk. It's not the 25-year-old who takes care of himself and eats healthy and works out every day. No, it's the 70, 80, 90-year-olds who, you know, who aren't as who doesn't have a good as immune system as somebody who is younger. So, I encourage you guys to do the same, right? Don't have the extent of this virus just be sharing stuff on Facebook and getting in arguments online. No, be part of the solution, right? And that is what good entrepreneurs do. So EM, yeah, rate cut is coming, yeah, because they're having a meeting in March, and history will tell you. I think 11 out of the 11 times when you had either a pandemic or such unpredictability and a sell-off in the stock market, you typically do have a rate cut that's coming. And well, let's talk about why, right? Jesus says, "Nah, let them kick the bucket. They lived a good life." Jesus, you of all people would say that? Oh my goodness, Jesus. All right. Um, but yes, what I mean, let's talk about what's really going on. What's really going on is that the market is being hurt more so by the panic, right? It's being hurt more by the panic of what's happening with this virus more so than what is really going on. You're talking about schools shutting down. The NBA, which sucks because I had courtside floor seats to the Bulls versus Nuggets in a couple of weeks here, but obviously I won't be able to attend that. But the NBA shutting down, the NHL, there was breaking news that the Masters, the golf tournament, has been suspended. So there's a lot of businesses being affected. You're all the way from restaurants to, I mean, not us. I guess, yet. I don't want to jinx it, knock on wood, just because we're an online business, and what we do is we do completely something different than. But again, it goes without saying, a lot of restaurants, businesses have been taking a huge hit. They've taken a huge hit because of this pandemic, because of this situation. And whenever businesses take a hit, that in turn reflects the stock market, right? It affects the earnings, and the stock market is a system and a complete ecosystem dependent on the performances of large publicly traded businesses. So it does affect travel industries. It affects a lot of different things. But again, like I said, the fear of what's going on is what affects the market more so. There's a huge sell-off that's going on, and history will tell you whenever you have situations where you have pandemics and you have economic craziness going around, the natural thing is for people to liquidate, and number two, hold on to that liquidity as much as they can. A lot of people don't believe, right? Like, these are the times where we want tangible, safe investments, which is why our channel being primarily dedicated towards real estate, I would argue is a good day for us. Not in the matter of we want people to lose or we want people to, but it's a good day in terms of a real estate investor, because you have a lot of capital that's going to be interested in investing in real estate. And at the end of the day, if you think about what real estate is a tangible investment. It is a tangible asset. No matter how bad things get out there, people will always need a place to live. My tenants still pay me rent regardless of what the stock market does. And speaking of the values of stocks, they still pay me rent based on the value of my apartment complex. My tenants are not going to come to me and say, well, Daniel, the apartment value has dropped $300,000 because the market cap rate went up 0.5%. Therefore, I'm going to pay my rent accordingly. No, they're not doing that, right? So apartments, real estate is, in my belief, a still safe, tangible asset. Do I think it's overpriced right now? Yes, absolutely. Now, let's go on to the meat. Let's talk about the rates, right? Because a lot of people are talking about you should buy stocks right now. It's a good time. Like I said, I don't agree with that 100%, right? I still think we should still see how things play out. And I know a lot of people are most likely going to say back to me the Warren Buffett quote, which, hey, be greedy when others are fearful, and be fearful when others are greedy. And, as a guy who's read a lot of Warren Buffett books and pretty much have stalked the man in terms of how he thinks and how he operates, I can tell you that, Warren Buffett also has said a lot of other things, in times like this. And I think when you have a generation of investors who have heard that statement, and they in turn do what other people don't think they're going to do, I think that creates an interesting phenomenon, right? So let me give you an example. All right, let me give you an example of what's going on. So the rate cut, yes, that is most likely going to happen when they meet again in March, right? So they cut down 50 basis points, 0.5%, to increase the liquidity in terms of what's going on in the market. A lot of people, the Fed saw the volatility, the panic that's happening in the stock market and the overall markets in general. And they responded with an emergency rate cut, meaning that they want the money supply to increase. They want it to go up, so that way that the markets can stabilize. And obviously, they're going to do that again. Now, a lot of people are talking about rates. Let me share with you guys something that nobody is talking about. Like, I have yet to see one article that talks about this, and in my opinion, is more important than the federal interest rate. So when we're talking about monetary policy as a whole, right? Because I read an article today, I read a headline for the last couple of days that the Federal Reserve is pumping $1.5 trillion, $1.5 trillion to what's known as the repo market. Now, for those of you guys that don't know what the repo market is, it is pretty much your your central banking system's operational fund. That's exactly what it is. So let's say that you own a business, right? You have your expenses and then you have your operational expenses. Let me put it to you guys in terms of apartment complexes, because we are primarily a real estate investing channel, and I am primarily a real estate investor. When I own an apartment, right? So I'm going to use a 36 unit building I own, right? So I own a 36 unit building in Illinois, and I have different expenses. Not all expenses are the same. So I have fixed expenses. I'm sorry, not fixed, but I have existing expenses such as taxes, insurance, right? But I also have operational expenses such as payroll, management, maintenance, right? Labor for capital, whatever that may be. I have operational expenses. So what the repo market is the operational expenses for the central banking system. Now, let me break it down for you guys even simpler. I'm going to talk to you guys if I'm explaining it to a fifth grader, all right? Because I've been trying to get better at simplifying my conundrums and explanations here. But the way that monetary policy works, and by the way, monetary policy is the system in which our economy is run, right? And if you haven't heard of it, I encourage you guys to Google it, YouTube it. You will get depressed because you will realize how much this economy and the banking systems and the insurance industries are really not out to help people. They're really out to help the few who own the entities that we are speaking of. And this is not a conspiracy theory. Like, this is happening in real life. Like, this is fact. So if you want to argue with me, you can do your best, but it's like arguing against 2 + 2 is 4. So let me break it down. The monetary policy is operated like so. There's 3 entities, right? There is the Federal Reserve, which is not a government entity, by the way. It is a privately owned entity. It's a privately owned organization, and they are the ones who pretty much print the money. And it's very scary to think about when you think about the very thing that prints money is owned by shareholders, by private people. So you have the Federal Reserve, and then you have the central banking system. That is pretty much our good and neighborhood-friendly banks. That's your J.P. Morgan Chase. That's your PNC. That's your Bank of America. That's Morgan Stanley. That is the central bank, right? And then we have the consumers. That's the last and final, pretty much, sector of this 3-piece monetary policy. We have the consumers, which is us, right? That's the investors, the people that take advantage of the programs that these central banking systems offer, aka home equity line of credits, commercial loans for real estate investing, residential mortgages, whatever that may be, right? So the way it works is that the Federal Reserve, they print money and they issue money to the central banking system. So a lot of you guys might probably be asking, hey, or a 9-year-old might ask, hey, where do banks get all this money to lend to us? Right? Because I'm getting multiple, like multi-million-dollar commercial loans to buy apartment buildings. Average Joe and Schmoes, they're getting, $200,000, $300,000, $400,000 mortgage. Where are the banks getting this money to lend to us? Well, it's simple. They're getting it from what's known as the Federal Reserve. The Federal Reserve is the entity that prints money, issues out, right? And they borrow money from the Federal Reserve a little differently than how we borrow money. So banks have what's called 3 things. There's 3 things that mainly affect monetary policy. The 3 rules of the game, so to speak, right? You have your money supply, which is the flow of how the money is being transacted, right? And so we saw right now, if we're making in terms of relatability to what's happening with the virus and the pandemic, the money supply is slowing down. Many would say it's being halted, right? I mean, you're seeing the money being halted in the travel industry, right? President Trump issues out a travel ban. No more tickets in and out of Europe. And obviously, I looked up flights to Korea. That's my home country. Well, Chicago's my home, but, my native country. Just for fun, just for kicks and giggles, right? And I looked up how expensive would a flight to Korea be for myself, my wife, Lisa, my brother, Sam, and his wife, Grace. Just 4 tickets. By the way, a typical ticket to Korea per person, probably between $1,200 and $1,700 per person, right? Keep in mind. So with the 4 of us, you're probably looking at between $4,800 and also it's $17, $6,800. So you're looking about a good chunk of money, right? Like a really good chunk of money. So tickets for 4 people a direct flight from Chicago O'Hare to Korea Incheon Airport, right, which is one of the largest airports in the world, is $1,100. When I checked it, it was $1,176. So you're talking about money supply being completely slowed down and halted, and that's what's happening right now. Same thing with the stock market. A lot of people are wanting to put cash out into the market. Federal Reserves, they do these things to make headlines so that investors feel safe about keeping their money in and buying and selling and keeping the economy normalized and stabilized the way it's supposed to behave and react. So you got the Federal Reserve, who you got the money supply. That's one thing. And then you have what's called the interest rate. And we all know our good and friendly federal interest rate. That is the rate in which the Federal Reserve lends money to the bank. But here's something that no one talks about, and it's something that I alluded to earlier. And it's what's called the reserve requirement. And the banks have this thing called the reserve requirement that every bank has. I don't care if you're Bank of America. I don't care if you're Mr. Jones started your bank last night with $2 and you're going to lend out $1. Every bank has what's called a reserve requirement. That is the amount that is necessary in liquid reserves in order to borrow from the feds. So let's say you wanted to borrow $1 million from the Federal Reserve to loan out to regular Joe Schmo consumers. All right. You need to have a minimum of $100,000. So here's how monetary policy really works out there in the real world. I have $50,000 that I want to put in the bank. I want to put it in the money market. I want to put it in the savings account, et cetera, whatever it may be. I'm going to give you that $50,000 to the bank, right? What the banks are going to do in turn is they're going to take that $50,000. They're going to put it in their vault. They're going to put it in their reserve requirement. And then they're going to go to the Federal Reserve and say, hey, listen, we have $50,000. Our reserve requirement, historically speaking, is 10%, which, by the way, that is pretty much universal all across the board. It's 10%, typically speaking, right? However, they have the Federal Reserve has the ability to change that because the Federal Reserve is the bank for the banks. They have the right, like the banks do with us, to change the terms of the deal, to change the terms of the agreement. So they could say 15%, 5%. It has happened. It doesn't happen a whole lot. It doesn't happen as often as the federal interest rate changes, but it does happen as more often as you would think, right? So you have the reserve requirement, $50,000, and then they're able to borrow $500,000, $500,000 from the Federal Reserve to then loan out to us, which is a little crazy, right? Because on one end, you're going from like, so if the federal interest rate is 1%, then they would give us 4% and they make money on that 3%, which, by the way, ladies and gentlemen, that 3% is not a small number. Number 3 may be small, but man, that is a lot, right? It's a lot like, hey, how many heart attacks in a life is too many? 0, I mean, 1 is too many, right? 3 would be astronomically a huge number. Kind of the same thing, right? Kind of really the same thing. 3% is a lot of money, right? Kind of like how money managers make a 2% management fee for managing your portfolio, right? Financial advisors. Fun fact, right? 401k. If you have a 401k, that 2% money management fee by the end of 30 years, just 30 years, which, by the way, a lot of Americans have a 401k a lot longer than 30 years, ends up being 66% of all gross profit. 66% of all gross profit, right? Just from that little 2% management fee. But anyway, that's video for another day. So they make 3% on that spread, and then they charge you an amortized rate, which obviously, if you're part of this channel, you know exactly what I'm talking about. But that reserve requirement is huge. And now let's backtrack. Let's talk about a couple of headlines that I read this morning that affect our market. So the federal interest rate are lowering their rates. Yes, right. There's a lot of people in CNBC and all these people that will tell you about it, which I never really trust the news anyways. I listen to it for data purposes, but I could care less about their opinion. The rate, yeah, important. But let's talk about the reserve requirement. Because what they're trying to do is, in order to keep the monetary policy alive and well, the banks, right, need to stay alive and well. If you want to talk about what happened in 2008 and 2009, the big problem is that a lot of the banks shut down. And because a lot of the banks shut down, a lot of people lost their money. They lost their shirt. And if you want to think about how much the banks affect our investing life and our investing career, it's a lot, right? I was just telling, Ricky this morning, if you think about the asset that doesn't have to do with banks as much as real estate. And even with real estate, if you want to think about how many people refinance, right? I mean, you think about how many people right now, especially, right, with low rates, they want to lock in that rate. So they go ahead and they refinance. Think about how much of real estate depends on the banks as well. It's nuts, right? So if the banks go down, well, I'm sorry to say, a lot of our investing, a lot of our money goes down as well. So what the feds are trying to do is, because I read an article that says they pumped $1.5 trillion into the repo market, which we've already discussed is the banking operating budget, right? So what they're trying to do is the Federal Reserve is trying to foot the bill of the banks trying to stay alive. And what the banks are doing is exactly what we are doing right now. We are liquidating as much as possible, and we are holding on to everything as much as we can, like as if it's toilet paper, right? That's what we're doing right now. So what the banks are doing, to go back to the reserve requirement, and this is my theory. Maybe I'm right, maybe I'm wrong, but it's something for us to speculate about and at least keep the conversation going for the sake of educating ourselves to see what the best move is moving forward in all of this uncertainty, right? My theory is that, yes, they pumped $1.5 trillion into the banking repo system to keep the banking system alive and well. But I have another theory. That what they haven't announced as much and what they've done behind closed doors is that they've reduced that 10% reserve requirement to 5%, potentially even 7%. And again, like, I've only read a couple articles on this, so maybe I'm wrong. All right. If you are more educated on this topic, please email me at info@thekwakbrothers.com and let me know what your opinions are. Please educate me. Because again, this is a discussion. I don't want this to be a one-way street, right? Markets don't work like that, nor should this YouTube channel. But my theory is that they lowered it to 5% to give pretty much double the amount of liquidity for the banks to be able to not borrow money, but also for them to stay alive and lend out that money. It gives them a lot more power. I mean, going back to our example, for those of you that have stuck around this entire time for the last 22 minutes and 28 seconds, is that $50,000 example. They no longer need $50,000 to get $500,000. They only need $50,000 to get $1 million. $1 million. Which, what does that do? Which is, again, going back to what I've alluded earlier of people saying you need to buy stocks right now, and me saying I don't know if I necessarily agree with that. I don't know if I necessarily agree with that wholeheartedly, because whenever you have historical data, right? If you look back in history, right, the great Ken Fisher and the great Warren Buffett have both said on the record that what they're seeing in the market right now reminds them a lot of what they saw in the 1930s. 1930s. So I don't know if I wholeheartedly agree with that, because if you look at what happened in the 1930s, if you look at what happened in the 70s, and even arguably in the late 90s and the early 2000s, you've had a moment for a couple months there, for a couple 2-3 months there, where you've had the last speck of the Federal Reserve looking to reliquidate the market have created a new surge. It's created a new surge, an almost a false sense of security. And I'll be the first one to tell you guys, I am not an older individual. I am, as many would say, still wet behind the ears. Right? I'm in my mid-20s. And no, I was not an investor when the last recession happened. But I have made it a point to ask a lot of individuals in their 40s, 50s, and 60s and 70s who have seen multiple recessions, and I've asked them specifically what they believe what happened, what are their ideologies, and I can say from a place of confidence that I've asked those individuals a lot more than the average person, right? One would argue that I have a more access to those type of individuals due to my network. And I can tell you that in every single time there has been a period where stocks agreeably were low. And then they resurged back again because of the last minute efforts of the Federal Reserve to reliquidate the market. And then after that is when stuff hit the fan, right? They really, really hit the fan. I don't think it's an accident that Berkshire Hathaway, Warren Buffett's company, has reached records in terms of how much liquidity they have had since 2 years ago. I think when they first hit that record, it was 2018. I was running a mastermind with part of another organization. And I remember looking down at my phone and reading that news that Berkshire Hathaway has broken their own record for the amount of liquidity that they hold in their shares, in their markets, right? And I believe that they haven't bought anything yet. And I think there's a lot to be said about that. So is it a good time to buy stocks? I don't know. I'm not confident in that answer. I will tell you, I am more confident in buying an apartment complex right now that is off market, that is not on the table of different competitors who also have access to capital right now, because it's tangible, because people will still pay rent regardless of what pandemic is going out right there. And I think it's interesting to see what's going to happen. And the question that we have to ask ourselves right now is just how good is the market currently? So let me know what your guys' thoughts are. These are things that's happening right now. Right? Robel just made a comment. Fed has been active in repo markets since September of last year. Absolutely, they have. When repo markets spiked up to 10%, I think banks, hedge funds are hesitant to engage in repo operations due to illegitimate collateral. I 100% agree. 100% agree with that. They did $540 million. I'm sorry. I think they did $540 billion in December of last year. And I believe starting October 18th or 19th, they pumped, I think something along the lines of, and I don't remember, you have to excuse my memory. I think they pumped somewhere along the lines of $50 billion every single day until November 9th, I believe. And you'll have to excuse me, but the only reason why I know that is because I got married in October 11th. And I remember reading that news that they announced that they're going to have this period of couple of weeks where they'll be pumping money every single day into the repo market. So they've been doing it, people. They've been doing it long before this pandemic, this medical virus was a thing, right? To my knowledge, things are still going as planned, right? So absolutely. Thank you, Rebel, for that comment. But let me know. Let me know what you guys' thoughts are, right? Email me at info@Kwak Brothers. Let's have a discussion. Comment down below on the stream. The stream's going to get recorded. But thank you, guys. I appreciate it. Let's see what happens. Just how good is this market?